sponsor a 401k for your employees or are considering for the first time, we're going to help you define some of those basics to successfully manage a retirement plan for your business. And today is actually part one in a two-part series hosted by ASAP. And in today's presentation, we'll clarify ERISA and break down some of your fiduciary responsibilities for sponsoring those defined contribution plans such as a 401k, 403b, or 457. And this webinar is actually sponsored by ASAP Accounting and Payroll, and ASAP started in 1990 in Telluride, Colorado. We have 3 regional offices in Telluride, Durango, and Denver, and assist clients with payroll processing and bookkeeping services. At ASAP, it's our aim to make things as simple as possible, and really we have the goal to get you back to doing what you love. And with that, I want to introduce our speakers today. I have Mike and Bill with the Clements Group based out of Durango, Colorado. And the Clements Group offers a full range of investment products through Securities America with an emphasis on retirement accounts. And as investment advisor representatives, they used a tactical management solution in order to help their clients pursue their goals. So without further ado, I'm going to go ahead and stop my video and turn it over to Bill and Mike.
Diana, thank you so much. My name is William Clements, and I'd like to introduce, sitting to my left here, Mike Bolster. Mike is our 401k expert, been with the Clements Group about 13 years now, and really focuses on participant outcomes through great service and good investment basics.
Thank you very much, Bill. I'd like to introduce Bill Clements. Bill's father started this company 30 some odd years ago, and Bill is the acting guy driving the company right now. Bill's been in the business for about 18 years, right out of high school, all the way through his college education. Bill is a registered principal in the securities industry and is acting as a registered rep with us today. So with that said, guys, we'll dive right into the content.
So how to set up and manage a 401k. Again, this is Mike Bolster and I'm Bill Clements. And please note that we are both accredited investment fiduciaries, or AIFs. As we dive into this, we'll make certain you understand what a fiduciary is. First and foremost, we like to bring to you a basic 401k example or case. And to keep this really simple, we figured that a typical company might have 10 employees, that they might do a 4 or a 5% match, and that if so, with a $50,000 annual salary for each of those employees, and if they contributed the 5% to get the match, that you would have about $5,000 in contributions per participant, which equals for 10 people about $50,000 in annual contributions. Additionally, we listed an average annual expense of $2,000 to $5,000, the $5,000 being on the high end if you're starting up a plan, $2,000 being more of a maintenance or ongoing cost. Additionally, we see some good tax savings in contributing to a 401k for the employer versus paying that out in payroll. Mike?
So guys, let's look at a few outcomes. If you follow this formula, and if you follow a 5% contribution on your $50,000 salary, and you receive that 5% match, if you do this for 30 years, and if your investment advisor makes an average return of 7.2% a year, you're going to end up with very close to $700,000. It's a nice chunk of money. If you go ahead and increase your contributions during this 30-year time frame by 10% a year, so i.e. you've put in that $5,000 the first year and you increase it by 10%, everything else stays the same in this formula, same employer matching, same rate of return for that 30 years, your outcome is more like $1.4 million. That's a whole lot of extra dollars just by increasing your contribution slightly. And then here's the one I think is the most telling, guys. If you put $0 into the plan and you get $0 in matching from your employer, you're going to end up in 30 years with a big red fat zero. It's our job to make sure nobody ends up with that big red fat zero.
Guys, moving on, we wanted to talk just a little bit about setup. And I think the first key is to understand whether or not you need a 401k. And often people ask us for that general guidance. And in a very quick few bullet points, I would say 5 employees and $30,000 to $100,000 in contributions are really the sweet spot for a 401k. There's a lot of expense and fiduciary details that need to happen in order to have a full-blown 401k plan. If not, you might consider a SEP or a simple, as they're a little more participant-based, or an additional type of small business plan. Additionally, we wanted to point out who to contact and who will help you with the duties of a 401k. Mike?
Okay, so if you're looking to find out information to whether you want to start a 401k plan or not, really the first place to start is with your investment advisor. The investment advisor in this whole setup is sort of like the conductor of the band and will work with a lot of other people in the plan to make things happen. But in general, the financial advisor is able to reach out to these third-party administrators, all the platform sponsors, and to figure this out for you. And one of the things that your investment advisor should know is all your duties and responsibilities, particularly from a fiduciary status. We're going to talk about that. The advisor can help you overview your different service providers and look at who might do what. And also they should bring you 3 different quotes, 3 bundled quotes from different service providers as part of your due diligence to look at that overall field out there, and then you can make choices from there. The second person that you'll probably end up talking to, and this may be referred to you by your financial advisor or may not be, is a TPA, and that is what is referred to as a third-party administrator. And the third-party administrator is really the bean counter in the plan, and they keep track of every person's contributions in all the places. They take care of the contributions and the matching. They understand the tax implications, but as well, they're the firm that will write the document that is specific to your plan. Each plan may have some specific needs in these documents, and so the TPA is a person that you'll work with to look at those needs and decide the actual pieces and parts of your plan.
The way I like to think about it, as Mike showed, was that the financial advisor is often the conductor or the leader of that band, while the TPA may be the first fiddle or maybe the drummer, which keeps us on beat. The TPA, I always like to think of as a very fancy accountant that helps the plan continue to get the things done it needs to be compliant and to have successful outcomes. Those things might include a Roth provision, if you're interested in Roth IRA dollars, or in setting up the eligibility period. Again, many of the specifics the TPA will deal with. Guys, next we wanted to give you a little primer in the difference between defined benefit and defined contribution plans. Defined benefit plans are typically where we've come from. I often think about this as my grandfather's pension and him receiving a gold watch. This is a set amount of payment per year or per month as a retirement benefit versus a defined contribution, which Mike will tell you a little more about.
Guys, a defined contribution plan we would typically refer to as a 401k plan. There are some other defined contribution plans such as a 403b and a 457 plan, and we'll talk about those briefly. But really, a defined contribution plan says the employee is allowed to put in a certain amount of dollars into the plan each year. The employer is allowed to match it with a certain amount of dollars, and then the final overall contribution number can be reached by a profit-sharing component of that plan. But just like the definition says, it's a defined contribution. And so for the average employee that's under 50 years of age, you're allowed to put in $18,500 per year maximum into that plan. Now, there's a whole lot of ways to reach these numbers, but that is the maximum contribution that one employee under 50 years of age may put in.
From our slide here about when you set up a 401k, next we touched on defined benefit, and then finally defined contribution, which is your 401k or most of our 403b and other contribution-based plans. Next, we wanted to talk a little bit specifically about each of those plans. And I'll start this by simply saying, when I think of 401k, I think of a company retirement plan. When I think of 403b, I really think more of churches and schools, those tax-exempt organizations. And then finally, a 457 plan typically refers to nonprofits, those kinds of plans that have government-based or nonprofit employees are the 403bs and the 457s. But for today's conversation, they all have about the same setup and the same overriding principles or guidelines, especially as a fiduciary.
Yeah, absolutely, guys. And most of you are familiar with the 401k. You don't need to waste a lot of time, looking at 403b or 457 unless you're in that space. Most private companies fall into the 401k space. So here's a quick look at all of the people involved in the setup and the management ongoing of a 401k plan. The company is the first leg, if you will, or maybe even the bench of the stool. Without the company and the need to sponsor a plan, there would be no plan. So in general, the plan sponsor is the CEO of the company, though it may be the CFO. Generally, head of HR is not the plan sponsor, but they'll have a role in setting up this plan. Then when you look at the service providers, you'll see a record keeper, a third-party administrator, which we've talked about, and then the financial advisor. The record keeper literally does that. It keeps the records of all the participants. They will often be associated with a custodian, and the custodian is the entity that holds the money at the end of the day. Clements Group does not have a safe in their office with all of our participants' money. That is held at a custodian. The record keeping and the custodian functions may be performed by the same company, and as well, the third-party administrator and the record keeping may be done at the same company, or you can use two separate providers for the record keeping and the third-party administrator.
Depending on how complex your plan is and how many participants you have, what options you selected will determine whether you want to bundle those features or to break out and hire professionals for each of these. Typically, as Mike said, we do see a couple of these bundled together, and almost always the financial advisor is sort of the leader of that band, with the plan sponsor being, as Mike said, the bench or an integral part of that four-legged stool. In today's society, my industry is really struggling to define and understanding that it's important to define fiduciary. And I think I learned this lesson very well from my father about 19 years ago when I started here as a little grunt pushing paper from one side of my desk to the other. And that is really that we must do what's good for the client first and foremost, above all else. And then it must be good for the company, and finally it must be good for us as financial advisors. If we don't do all three of those things and in that order, quite frankly, it's not worth doing. But Mike, once again, help us with a little more technical definition.
Sure. I mean, I'm not going to read this definition word for word, but the way I like to think of it is absolutely, if you cannot say that it is best for the client first, you cannot continue down that path. And a fiduciary must act in the presence of the prudent professional in his situation, not just the prudent man. So we're held to a much higher standard for the care of our clients. And truly, this means that if the financial advisor has to make a decision that is better for the client and less for the financial advisor, you have to go that way all day long. So it really just means acting in the best interest of your client at every step of every transaction.
I couldn't agree more. If I added one small detail, it would be to also disclose conflicts. You hear a lot about mutual fund expenses and needing to disclose that one might cost slightly more than another, or that one has a different feature than another. And so we really always try to put our clients ahead of our interest and to ensure that we disclose those conflicts. Guys, next, let's define some fiduciary roles and responsibilities, starting with the 338 fiduciary, number 3. This is the fiduciary roles and responsibilities that a firm like mine will take on to ensure that all of the day-to-day activities are taken care of for the plan. They oftentimes include keeping a file cabinet, making sure that plan oversight is done, and then the 338 fiduciary taking enrollment, education, and investment lineup. Next is a 321 co-fiduciary, and finally a 316 specialized fiduciary.
Guys, we generally work as 338 fiduciaries. The 321 is a co-fiduciary that still leaves the plan sponsor with a pretty fair amount of fiduciary responsibility. And by being 338 fiduciaries, we take most of that responsibility from the plan sponsor, which is generally what that plan sponsor wants. And a 316 is really, it's a nebulous little term that doesn't do a lot. It's basically letting your record keeper do light fiduciary work for the plan. It doesn't really bring a lot of education or anything like that with it. So we prefer the 338 status. We'll show you why.
Here is a real plain example of the 5 major fiduciary duties, and we hope to emphasize the fact that employee education, enrollment, and investment lineup can be outsourced, with file cabinet and oversight remaining with the company or plan sponsor.
In general, your financial advisor, if he's acting as a 338 fiduciary, they can help the plan sponsor fill the file cabinet with the proper documents, such as summary plan description, investment policy statement. Any documents pertaining to the plan should be in that file cabinet. And then the oversight portion, the financial advisor can help the plan sponsor shop. You know, generally we bring 3 different options to our plans every other year just to make sure that we're competitive and that they're in the right space. When we get to the last 3, the education, the enrollment, and the investment lineup, this is really where the 338 fiduciary shines. What Department of Labor really wants to see most right now in 401k plans is education. And having your financial advisor come in on a regular basis to educate your people, that's the best that you can do for Department of Labor, and they love to see that. But the thing that'll get you sued the most by Department of Labor is your investment lineup. And so if you, the plan sponsor, decide to keep the responsibility of making that investment lineup yourself, you're shouldering a lot of fiduciary responsibility. And by letting the 338 fiduciary run with that investment lineup, you've transferred as much of that fiduciary responsibility away as you can. And there's actually 2 sides to the investment lineup coin. If it's a 30,000 person company like Ralston Purina, they're going to have the most basic generic fund lineup you've ever seen because it keeps them from getting sued. If you work with a specialty company like ourselves, we're going to have 30 to 40 very highly screened mutual funds in place for your participants. We kind of lean towards the other side of the thing. So understand that investment lineup is a very important piece of this fiduciary duty.
You know, Mike really talks about the education, and I think the duration at which education done is the key. For most plans, it must be done every single year, but a much better practice is to do it 2 or 4 times a year, and to then cover enrollments at that same time. I think eventually Department of Labor will lean on companies to make sure that they've either auto-enrolled participants or that they're getting a good opportunity to enroll. Because as Mike pointed out a few slides ago, the biggest way to lose with a 401k for a participant is simply not to enroll. And so these are all very important, and your financial advisor should and can help you do these things. Let me point out one conflict here, though. If they are not a 338 advisor, they're not doing this as a full-fledged fiduciary, they're putting themselves in conflict with the plan and with you, the plan sponsor, because they're giving advice outside of their scope. Something to be very, very careful and mindful of here. With that said, we're once again to questions. Please, guys, any questions pertaining to 401ks, setup, any fiduciary duties, we'd sure be happy to answer.
I've got a question. I can't seem to ask it anonymously, but can you define like vesting and talk a little bit about that?
Sure. Vesting is generally a schedule put on the plan to retain employees. And a typical vesting schedule would be a 6-year schedule, in that after the end of the first year, the participant becomes eligible. And then at that point, they start contributing. At the end of their first year's contributions, they're generally 20% vested. And let me explain vesting a little more. I'm sorry, I got ahead of myself. Vesting refers to the matching contribution from the company. So an employee's contributions of their own are always their money, and they're 100% their monies. But it's the matching portion coming from the company that will be subject to the vesting schedule. And so let's just pick a match. Let's say a company matches 25 cents on the dollar up to 25% of pay. That would be a very nice match. The employee would receive 20% of the company's money if they left after that first year of participation. Typically, that would go 20%, 40%, 60%. At the end of 5 years, that participant would be 100% vested in the matching component from the company. Now, to really get technical, there is a situation in 401k plans called a safe harbor plan. If a company elects to use a safe harbor plan, I'm not going to go completely down the rabbit hole of what that is. We can address that later. The participant is always 100% vested in safe harbor matching contributions immediately. There's no vesting schedule on a safe harbor plan. Does that help?
Yeah, definitely. And we did get one question come in. Would you like me? I can ask the question for this person. We are a religious 501c3 nonprofit. What are the most common things and important things to research in terms of a 403b or 457 plan? Pros and cons of the two.
Bill, why don't you take this one?
Excellent. You know, really, I think the thing to know isn't based around 457 or a 403 plan. Those are ERISA qualifications, which your financial advisor and your TPA will help you make sure you're under the right code. Under a 501c3, I would assume that you're going to use a 403b type of plan because it is for a tax-exempt charity.
Or church.
But more importantly, the real thing to understand is who you're using as your service providers. Are they in line with your values? And are they providing the services that you need, just as if you were a corporate 401k plan? I think that is really more the meat and potatoes of this.
Yeah, I would agree, Bill. I think that the function of all three of these plans is very similar as far as the contribution limits and how the money flows. So it really is just a matter of being sure that you're under the right classification. Moving forward from that point, the plan is going to run essentially much like a 401k plan. There won't be any functional difference in the day-to-day operations.
Another question that I would pose on the group's behalf is, what happens when I get ready to leave my 401k, or when I, as a participant, am fired or choose to retire?
Sure. 4 different options for that. And these are ERISA options that have just come down the line in new ERISA fiduciary law. So a year ago, we used to give these options to our clients. Now we have to make them sign a form that says we have actually gone over each option and explained them to them. Your 4 options are leaving the money in the old plan if permitted, rolling your monies to a new company plan if your new employer sponsors one, rolling those monies to an IRA that you can control, or the 4th option, which we think is the worst option, is cashing out that 401k balance. That generally results in a 10% penalty, excess taxation of that monies, and it's your worst option in general. So there are options to move the monies once you leave the plan, but let's see if anybody has questions on setup and function of the plans for this point.
I'll ask another question. If an employer is not ready to budget for a match, can you still set up a 401k or 403b, 457?
Yes, absolutely. And I see this fairly commonly. Most matches in a 401k plan are set up as a discretionary match, meaning the company may or may not make that match on an annual basis. And I work with some companies that each year look at cash flow, and in October we'll run them some projections to look at what different matchings might mean and how much cash that will cost that company. They have the option at that point to either fund that matching for the year or not fund that matching for the year. So you can certainly set up a plan that doesn't have a match attached to it, or you can set that plan up with a discretionary match that the company is not held down to their toes are not held to the fire to make that match. But I will say that I see participation in plans with a match much, much higher than ones without a match. Remembering that that matching contribution from the company is a direct tax write-off. So it generally works out well for the company to do a small match.
Additionally, we've received an additional question. Let me read that question for the group and then answer it and expand on it just a little bit. There already was a 403B plan in place for my school. Often employees ask me for investment formula advice, and I tell them to call Tia Kref, which is the company that hosts our plan. Each employee has access to their plans. Is that the right answer? First of all, great answer in not trying to give them financial advice. Believe it or not, that would be against the law as you're not a registered investment advisor. But your host company is a great source. And in a 403B, each participant may retain their own financial advisor. So if you don't feel like you're getting the help you need from Tia Kref at large or the plan advisor to that 403B, you can look outside. Honestly, I wanted to expand on this to include two more details about 403s and 457s, which are slightly different than a 401k. First of all, a 403b, as I said, you can hire an outside financial advisor or place the assets on your own as a participant. They allow that within these types of plans so that folks can get this good investment advice, and they do need it. Second of all, they don't have quite the restrictions on pulling the money out. If you pull it out before 59.5 in a 401k, you're exposed to a 10% penalty tax. In a 457 or a 403b, you may not be. Now, I didn't say you won't be. I said you may not be. Finally, let me just give a little broad, quick investment advice to answer this question, which is, if you've got 30 years left, you can save $5,000–6,000 a year and have a very successful outcome, as Mike showed. And if you escalate that, if you start at $5,000 and then go to $5,500 and then $6,000 and continue to escalate, you might be quite wealthy with what you're able to save there. However, if you've only got 5 or 10 years left, even if you put the maximum in, you may not have enough time. So my best, very general advice is that retirement and saving in a 401k is a very long-term game, and one that's won by $20 at a paycheck for 30 years, not $1,000 a month in 10. Mike, please add and elaborate.
Sure. In general, I agree with Bill's answer on that. You definitely don't want to give your friends investment advice. Certainly water cooler talk's fine, but understand that it is against the law to give specific investment advice. Actually, for a financial advisor that's not a 338 fiduciary, they're not allowed to give specific investment recommendations. So I think starting with TIAA CREF is a great place. Each person is going to have their own investment formula based on their age, their time horizon, their risk. Remembering, guys, risk is not just age, but it's personality as well. So there are many factors that go into that. Does that adequately answer that question for you?
Yeah, definitely. We did have one question come into the chat box. Let's see, on one of those slides, it said the annual cost to the employer would be between $2,000 and $5,000. Is that a management fee, or can you elaborate if that's a flat percentage or how you came up with that estimate?
Sure. In general, the annual costs of the 401k plan are going to be ongoing about $2,500 a year to the third-party administrator, and that's a pretty fixed cost. However, that third-party administrator may have an additional basis points cost of even 0.05 basis points, and they're going to take that on the assets of the plan continually. As well, the record-keeping company, sometimes they'll do a flat fee for record keeping between $300 and $500 a year. Other times they will work on a percentage of assets as well, and that range tends to run between about 24 basis points and 46 basis points, so approximately 0.25% to 0.5%. Additionally, in the cost of this plan, if you're using a 338 fiduciary that is actually managing the assets of the plan, there would be a management fee for the financial advisor services as well. And so I didn't use a specific flat percentage, but I used a little pieces and parts of all of those different providers' costs to come up with that number.
And I would add to that to say that it's very plan specific. If you have a 200-person plan with $2 million in it, honestly, that cost could be 3 or 4 times our real basic estimate. Really, to me, this highlights the need for companies to understand what expenses they're paying and exactly who they're paying to them to. For years and years, we heard plan sponsors say, our plan is free. And it was quite laughable to me because nothing is free. And honestly, oftentimes these expenses can be hidden in the plan costs by what you pay a fund. Some advisors charge a fee that might be comparable to a 338 advisor's fee, but yet don't provide the services. One of the things a good, reputable, accredited investment fiduciary or investment advisor representative should help you do is to discover the cost either as you set up or as you review your plan. Let me follow up with one additional question here, which says, I can't remember seeing this in the early slides, but you mentioned that a SEP or simple plan could be used. Would an organization use that if they are matching less than 5% for each employee? Also, do you recommend the 403B over the simple? Mike?
I think the defining answer to whether you use a simple or a 401k is the contribution limits. A simple plan allows a participant $12,500 a year in contributions. The base starting point at a 401k plan is $18,500. Simple plans are very inexpensive to run, but they'll tend to come with a little bit less of a robust investment lineup and a few less features. So if you're a 3-person company and each person wants to flow a couple $1,000s a year and not get anywhere near those 401k maximums, simple might be a great place to start. If you're a 3-person doctor's office that everybody wants to max out, take absolute advantage of the tax savings, in that case, even though it's a very small company, you would probably head towards a 401k because those administrative costs are kind of peanuts compared to what that group can put away. I'm going to take the 403.
Let me next cover a question we received anonymously, and then I'll come back to this stream of questions. The next question we received says, what are your thoughts on 401ks being initially started as part of a 3-legged stool of Social Security, 401k, and a traditional pension, which we no longer see? Are we in retirement trouble? The answer is yes, we are in retirement trouble. And let me sort of frame this up in this way. My grandfather received, and he was an engineer for Texaco. He received a gold watch and a pension, and that pension would have covered both he and my grandmother's retirement. But in addition to that, they received Social Security, which gave them a 50% cushion, meaning they had 50% more money every month than they could spend. Today, those pensions are simply gone. And the reason they're gone is because Texaco and Ford Motor Company and a number of companies found out later that they could not continue to fund and pay for those events after those employees left. Honestly, it's a problem for General Electric today in their legacy costs. The 401k then became the investment vehicle of choice, replacing that pension. And it probably was enough, but with inflation and with our challenge in Social Security benefits, what I advise folks to understand is that my grandfather got a full retirement out of Social Security. My dad will get a nice house payment out of Social Security. And I think I will get a Toyota Corolla payment out of Social Security every month. So, folks, your challenge as employers is to provide a great 401k so that ultimately your people can retire.
And in general, at the end of a person's working career, their 401k plan balance is their single biggest cash asset that they have. So we kind of are in trouble. I mean, the statistics would say that 1 in 3 people out there have no retirement savings. We certainly can't help those people, but we want to help everybody move down this path of retirement that we can. We're going to switch back to the question about the 403B plan and the simple. One of the delineating factors between the two would be the non-tax or the non-profit on the 403B side. The simple IRA plan, the participant is going to pay taxes on the gains of that money throughout the career of that plan, whereas in a 403B, a tax-exempt organization, you have much better tax treatment. So it's really more the status of the organization in this case that would determine which way you would go. As far as the matching, a simple plan generally does a dollar for dollar 3% match. So it's a little lower match than a 5% match, but it's still a very competitive match. So at that point, it's more determined by the structuring of your company. Are you a nonprofit, or do you need the higher limitations of contributions based on the 403B plan? As far as conversion, simples are a little bit tricky when it comes to converting.
They are a wily cat.
They are. And so, for example, if you move monies out of a simple, even to another qualified plan in the first 2 years, they hit you with a 20% penalty. So it's important to kind of look at the long-term structuring of the company, because if you think you need a simple now, but in 1 year you might need a 401k, you'd probably want to go straight to the 401k. So there are definitely quirky rules concerning rolling simples to other entities.
Guys, we're moving beyond our questions. If anybody has any other questions, this is the time. We just have a couple of slides here in conclusion. All right, moving on. And thank you very much for great questions. Certainly makes our life as presenters a lot easier. In conclusion, we want you to understand that if you are a fiduciary, you are the plan sponsor, and that we have an ability to help you understand those issues and to answer them. Also, a shameless plug here, along with ASAP Payroll, we will be doing a seminar on benefits this October, and we look forward to any of you attending that might be here in the local Durango area.
Everyone, we really appreciate you sitting in with us today. I hope you learned something. If you have more questions, feel free to contact us. This whole 401k game is a very, very complicated game. I've been in it almost 15 years. I know a lot of the ins and outs, and I have great resources that no answers to questions that we don't know. Thank you for your time today. We really appreciate it.
Thank you very much.
Yeah, and thanks.